what a Fed rate cut would mean for bank accounts, CDs, loans, and credit cards. This is the economic U-turn we've been waiting for. The Federal Reserve is expected to begin lowering interest rates Wednesday. It's been a long time coming. After inflation peaked at 9.1% in June 2022, the Fed worked to tame consumer prices with 11 interest rate hikes over the ensuing months. Rates have remained unchanged since August 2023. With inflation at 2.5% in August, tantalizingly close to the 2% target, Fed officials are signaling that they feel the time is finally right to steer interest rates lower. How monetary policy works. The Fed controls one interest rate, the federal funds rate, the short-term rate banks use to borrow from each other. The target range for the federal funds rate remains at 5.25–5.50%. Fed interest rate decisions filter through the financial world, impacting virtually every facet of borrowing costs and saving rates. Interest rate management is monetary medicine the Fed uses to slow the economy by raising interest rates in an effort to tame rising costs, high inflation, as measured by the Consumer Price Index. Help mount a recovery when we're at the opposite end of an economic cycle by lowering interest rates as an injection of liquidity into the financial system. Allow past moves to take root while the Fed considers future actions by holding rates steady. Here's how a benchmark rate cut could trickle down to your loans and accounts. How lower interest rates affect checking and savings accounts. Your short-term liquidity depends on money in the bank. As interest rates rose, so did deposit account rates. Soon, cash in the bank will start earning less. Savvy savers will need to hunt for the best returns as providers begin easing their interest rate payouts. Checking accounts. Checking accounts that pay interest offer the most meager returns. But you need quick access to the money, and if you manage your cash flow, the bank won't have most of that money in its hands for long. Interest-earning checking accounts paid a national average of 0.7% monthly in August 2023. A year later, that rate had edged up to 0.8%. That's likely the top of the tiny hill for checking account interest. Let's climb up the interest paid for cash mountain. Savings accounts. Short to mid-term money is best parked in a savings account. It's part of your easy in, easy out cash strategy. Last year, in August, the monthly average interest rate on a traditional savings account at a brick-and-mortar bank was 0.43%. Last month, it was 0.46%. High-yield savings accounts pay more. Yahoo Finance is seeing high-yield savings account APIs ranging from 4.25–5.25%. You can see that shopping rates really pays off. A PY is the result of compounding your interest rate. Compounding periods can vary by bank. Money market accounts. A money market account often boosts your return from a common checking account, but you'll likely need to deposit anywhere from $10,000 to $100,000 to earn the raise. Last August, the national average monthly interest rate was 0.62%. 1 year later, it is 0.64%. Consider putting your second layer of cash in an above-average money market account. It's the money you want close at hand, but not checking account close. To do that, look for a high-yield money market account. As the Federal Reserve continues to lower interest rates, high-yield money market accounts will start paying less. Yahoo Finance is seeing high-yield interest rates from 4.45% to 5.25%. What to do now? Shop rates at banks, both brick and mortar and online. Keep your near-term cash nimble and earning the best rate it can. Mind your money. What Fed policy does for CDs. A lower interest rate cycle would impact CDs too. A 12-month CD was earning 1.76% monthly interest in August 2023. A year later, the same term CD was paying 1.88%. The best CDs are around 5.25% APY. But remember, these rates were effective before the Fed's move to lower rates. Next month, we will likely begin seeing rates crawl down. Also, your minimum deposit and term will affect your rate. What to do now? Use CDs to earn interest on your midterm money. As rates fall, longer-term CDs may be your best option, while using other easy-access solutions for your shorter-term savings. What the latest Fed move will mean for loans and mortgages. Now to the other side of the asset/liability ledger. This is where lower interest rates can work to your advantage. Personal loans. Interest rates on personal loans have risen from 8.73% at the beginning of the Fed rate hikes in 2022 to 11.92% in May 2024, according to the latest data available. Student loans. Most federal loans have fixed interest rates, so Fed policy doesn't impact them. Private student loans may have a variable rate, and Fed rate hikes can be a factor. To learn the interest rate on an existing loan, contact your lender or loan servicer. Home mortgage loans.